You're going to do better buying boring, non-innovative companies at a good price than you're going to find by buying the crazy companies that are innovating like crazy at crazy valuations. This is probably the right time to start having this video discussion. So first off, if you're new to this channel, this is a different video than the other 2,000 we've done. I've criticized a lot of these hype investors. I put investors in quotes because they're not really investors, especially the likes of Cathie Wood. Cathie Wood's entire thesis is based on disruption. In her comment, when Michael Burry criticizes her valuation, she says, Michael Burry doesn't understand disruption. I believe Cathie Wood doesn't understand investing. She doesn't understand that when you buy a company, you're buying a future stream of cash flow. And when things are looking good, you can make all these ridiculous assumptions that make no sense. So the NASDAQ is the one index that has had the most disruptive companies. In fact, they run a commercial now. If you watch the national championship at any sporting events, they have commercials where this woman is sitting in one of those ice buckets, and she says, I'm an innovative investor. I invest in innovation, blah, blah, blah. I invest in QQQ, which I believe is the NASDAQ 100. So what I decided to do was, this is sounding a lot like the back in 2000, the dot-com. And the reason this is the better time to have this conversation is last year, the NASDAQ and the QQ and the NASDAQ 100 fell 30-some% versus the S&P, which still fell a lot, but only fell 20%. So I want to sit there and go back in time and look at the data on how well each one did. And was disruption really worth it? Now, a couple of things I want to say. The NASDAQ numbers I'm going to show you, the chart, does not include dividends. Now, the dividends to the NASDAQ are very low compared to the S&P, but the S&P numbers do show dividends, and I'll keep reiterating that. I feel like the NASDAQ's average is about half the S&P. So since 1996, 2000, when this data goes back, it's about 0.8% per year for the NASDAQ. If you want to call it 1%, that's fine.
Who cares?
Now, for those of you who say it's not a big deal, that actually is a big deal, and it does affect the results. So I will say that hopefully in every chart, because I want you to remember that the S&P number includes dividends, while the NASDAQ does not. But the question becomes, is it worth that kind of volatility? So let's take a look. So first off, I went to the chart going back to January 1st, 1996, because that's really when the tech bubble really started to get going. So it's the beginning of this big rise in tech. And I want to say, hey, listen, let's say you bought it back then in 1996 and you went to today. How did it look? So let's take a look at this. All right, guys, this goes back to 1996 to today. Look at this. The S&P is in orange, slightly beats the NASDAQ. Now remember, the S&P has dividends in here, so the NASDAQ is 1% per year compounded over time. What's the exact number? I don't know. So the NASDAQ definitely does beat. But does this 953% become 2,000%? Absolutely not. Absolutely not. And again, I didn't have a total return index going back to 1996 for the NASDAQ. But here are the keys. Look at these big rise and big fall. And for a long time, they're very much in step. My guess is when the end of this is done, this NASDAQ number is going to be a lot lower. Why do I think that? Well, let's look at our next chart. Our next chart does January 1st, 2000 to today. Here's the S&P. Here's the NASDAQ. Again, this does not include dividends. This dividend change would probably not make up for this completely. So the S&P from the peak of the NASDAQ bubble to today, the NASDAQ bubble back in 2000 to today, is not going to go very well. Did not go very well. And you might sit there and say, well, yeah, but you picked the best time of the NASDAQ, which is the peak. And well, great, but that's when hype is its worst. Hype is the worst when the stock market's so high. Back in February of last year, when ARK investment was at 160 a share, and we were telling people avoid it. Literally the comments below. Go look at our video. You don't get it. She has a hedge fund, which she doesn't. You do not. You think your process is better than hers? It doesn't. That's when you have to, that to me is when I really want to be the most cautious. And that's when I was exerting the most caution on these companies. ARK investments at 160 back then, and today it's in the 30s. I look at this saying that was only 2 years ago, and it's down 80-some%. So the more you pay, the less you make, right? The more you pay, the less you make. So just investing in the S&P 500 would have made you, let's say this still doubled, and it was 340%. Was that really worth it? to ride this huge drop. You might sit there and say, oh, it's not a big deal. This is a very big drop right here. So let's actually look at that right now. Let's look at March 1st, March 10th, which was the peak of the NASDAQ bubble, to the bottom of the bubble back in March 9th, 2009. Oh boy. A minus 73% versus 39%. Again, no dividends in here, but it's only 9 years of dividends here. So 1% a year for 9 years, even compounded on itself, is not enough to make up for this. That's the big thing here, guys. I want you to remember that. It doesn't double these returns. It doesn't triple. These dividends are substantial. And over a 25-year period, 1% a year does add up. How much does that add up? I'll tell you right now. 1% per year compounded on itself for 25 years is call it 30% more return. This is only 9 years. So it's about 10% more return. 73, if you're down 73%, instead you're down 63%. Are you going to be okay with that, being that far below the S&P 500? These are the things I talk about. Now, look at the annualized rate of return going back from January 1st, 2000 to today. For the S&P 500, it was only 6.4% per year. That's it. So even at the very peak of the bubble, only 6.4% per year. For the NASDAQ, it was about 5% per year, including dividends. 5% per year. Trailed the market. That's the big key here, guys. I look at this and say, guys, you have to remember that hype is hype. And in the long run, stocks are a weighing machine. In the short run, they're a voting machine. When you see these big bubbles here, when you see these big peaks, when you see all this stuff, this is when the voting machine is at its finest. And it just crashed down. From peak to bottom here was a minus 83% for the NASDAQ. And it took only 2 years. And I think we were at worse levels at the peak of our current NASDAQ bubble than we were back then. It was just different characters. Now it was EV and social media. Back then it was .com. And there is a time and place. The thing I recommend for you, if you want to buy innovation, buy it when nobody else wants it. Buy it when the NASDAQ is really, really down. Go buy it when all these, but you still have to buy fundamental businesses that are generating cash flow. If you look at the tech companies that survived back in 2000s, it was the ones with cash flow, except for Amazon. Amazon just grew like crazy and they were able to justify some sort of the stock price because they were still growing and reinvesting. But all the other ones had some sort of cash flow for the most part, or they grew like crazy. This is the big key to investing. And if this makes sense to you, you must subscribe to the channel because this is what we do week in and week out. We don't sit there and respond to the big ups in the market and say, this is great, or the downs in the market and say, this is horrible. We do the exact opposite. We're here to buy fundamentally sound businesses at fundamentally good prices. And when there's so much hype, back here, all the teenagers were in investing like me. Here, teenagers are in investing like I was. And it's probably going to end up going the exact same way of some sort. The S&P is probably going to outperform the NASDAQ going back to last year for the foreseeable future, probably for the next 10 or 12 years. Doesn't mean the S&P is going to be a great value, but still, if you believe in innovation and believe in the NASDAQ, at least dollar cost average. That way, as it falls, you're buying better companies at better prices. But when I look at ARK Investments, for example, and I see their top 20 holdings, I just look at that and say, this is a person who has a misunderstanding of what cash flow in businesses do. They have a misunderstanding of how to actually evaluate companies. The amount of shares being issued to dilute owners, the lack of cash flow, the lack of earnings, all she cares about is innovation. You're going to do better buying boring, non-innovative companies at a good price than you're going to find by buying the crazy companies that are innovating like crazy at crazy valuations. It's been proven time and time again in history. In fact, it's never worked out better for the masses buying innovation at whatever price. Literally never in history. You look at Bitcoin, same thing. We're going to look back at this time and we're going to say it was Bitcoin and EVs. That's what's going to end up looking back and going, oh my gosh. All you have to do is follow where the kids are going. Where are the young people flocking to? Cryptocurrency and electric vehicles. These are the stocks they absolutely love. Look in the last couple of years, what stocks have fallen. The meme stocks, the Bitcoin, the crypto. And I get it. Crypto's back to 2018 highs and it's rebounded from its lows and it's still above where I think it should be, but time will tell. Just like the NASDAQ took some time to weed itself out completely, 83% drop here, guys. Back in the early 2000s, 2000 to 2003, 83% drop in under 3 years. This is the way I look at it. If this makes sense to you, wonderful. If it doesn't make sense to you, you think I'm a wackadoo and an idiot and I don't get it, I don't blame you because the world's been different for the last 10 or 12 years. I just ask you one favor, that when this does work out the way I say it's going to work out, instead of hating me for it, just come back and say, wait, Paul said it was going to happen this way. He was saying it even when everybody else was telling him he was wrong. Maybe I should have listened to him. Thank you very much for your time. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?